Welcome to Talk Tickers. Today, we're diving into the Q2 2025 earnings for China Automotive Systems, that's ticker CAAS. Now, on the surface, this was a really strong report, but the way the market reacted, well, that tells a much more complicated story. So, China Automotive Systems came out swinging in their second quarter, posting revenue of a solid $176.2 million. And that number, that's an impressive 11.1% jump from the same time last year. A really solid beat on the top line.
But here's the twist. Despite those great numbers, the stock actually slipped a bit the next day. So what gives? What did the market see that cooled everyone off? Let's get into it.
Here's how we're going to break it down. We'll hit the Q2 results, then unpack their big strategic shift to electric power steering. After that, we'll look at why margins are getting squeezed, cover their guidance, and a huge new contract, and then wrap it all up with our take. All right, so the headline numbers for the quarter looked pretty great. But when you start to peel back the layers, you really see the tension at the heart of this story. And you can see that strength right here. Revenue's up over 11%, and look at that operating income. It shows fantastic leverage, jumping over 20%. But the number that's got everyone's attention is that gross margin, down 120 basis points. That's the real friction point, and we're going to come back to it. So where is that 11% growth actually coming from? Well, it's pretty much all about a really successful, ongoing pivot into higher tech products, specifically electric power steering, or EPS.
Just look at this. EPS products now make up more than 41% of their total sales. This isn't some side project anymore. It is rapidly becoming the core of the entire company.
And this slide, right here, really puts that growth into perspective. EPS sales exploded by a massive 31.1%. That is nearly 3 times faster than the company's overall growth rate. This segment is, without a doubt, the engine pushing the whole business forward.
And hey, this is not just a China story. The growth is global. Sales in North America were solid, and Brazil was just on fire, up almost 50%. The Americas now account for over a quarter of their total revenue, which is a fantastic sign of diversification.
Okay, now for the other side of the coin, and the market's biggest worry, margin compression. This is the headwind that's really keeping the share price in check, despite all that great top-line growth.
This slide just captures the central conflict of the quarter perfectly. On one hand, management did a stellar job controlling their operating costs, which led to that awesome 20% jump in operating income. But on the other hand, that solid execution got canceled out by a pretty significant hit to their gross profitability.
Now, on the earnings call, management was very direct about the two culprits here. First, increased tariffs. That's a macro issue hitting the whole sector. And second, a shift in product mix. Basically, even within their growing portfolio, some of the products that sold really well this quarter just happened to have lower margins. This is exactly what investors were zoning in on. So how did management respond to all these concerns? Well, they fought back with a very confident outlook in the announcement of a massive new contract. Yeah, despite those margin headwinds, they actually raised their full-year revenue forecast from $700 million up to $720 million. That's a huge signal of confidence in their demand pipeline for the rest of the year. And here it is, the big long-term catalyst. They landed their first ever contract for their advanced R-EPS systems with a major European auto manufacturer. This is a huge deal. It's expected to bring in over $100 million in revenue every year starting in 2027. It validates their tech and busts open a critical new market for them. And to add to that future-focused story, management confirmed during the Q&A that a full 80% of their R&D budget is now aimed at technologies for electric vehicles. They are absolutely focused on where the industry is headed. Okay, so let's put it all together. What's our take on CAAS as we head into the next earnings report? The central question for any investor has to be this. Are these short-term margin issues causing the market to completely overlook what looks like a powerful long-term growth and technology story? You can really frame the debate like this. The bulls are going to point to that incredible EPS growth, the confident guidance raise, that game-changing European contract, and a rock-solid balance sheet with $135 million in cash. But the bears? They're going to focus on the nagging margin pressure, the uncertainty from tariffs, and the simple fact that the market just kind of shrugged it all off.
So taking all of that into account, we are initiating our coverage with a market perform rating.
And here's our thinking on that. The company is executing its strategic shift into these higher-tech steering systems exceptionally well. The growth is real, it's impressive. However, that margin compression from tariffs and product mix is a major and valid concern. For now, those two forces are basically in a stalemate, which justifies the market's current wait-and-see approach.
And that leaves us with the final big question. The market right now is fixated on next quarter's margins, but the real value here might not unlock for a few years. Will milestones tied to that 2027 European contract be the thing, the catalyst, that finally forces investors to look past the short-term noise and reward this long-term transformation?
This is not financial advice.